All right, what's up, Mortgage Coach and Trust Engine community? I'm really excited about this interview. First time I've interviewed this special guest, but not the first time I've heard him talk. I was at the Housing Wire AI Summit, and Mike Shash. I knew I was going to say your name wrong, Mike. Sachdev. Did I get it right there?
Yeah, Sachdev.
It's just like it sounds.
Yeah, you got it.
Yeah, so he delivered just an incredible keynote. It was 24 minutes. It was data driven, talked about the mortgage industry at a very, very high level. And then he had some really data driven perspectives on where AI should be applied first. And he made a case for that. I thought it was really well done. And I thought it was something that every loan officer needs to hear, heads of production need to hear, Snapdocs for people in the mortgage space, probably your C-suite and your ops team. They know this brand. It's really gained momentum, but I want to make sure that the front end of the business, in front of loan manufacturing, knows about Snapdocs and some of the things that Mike was sharing. So Mike, welcome to the community, my friend.
Yeah, thanks for having me.
Yeah, if you don't mind, just because you came from outside the mortgage space, if you don't mind just giving quick on your backstory and your role at Snapdocs.
Yeah, happy to. I grew up in Pennsylvania. My dad is a owner of a manufacturing business. Grew up around manufacturing. I bring that up because manufacturing is a low margin, high velocity business, and when you run that kind of business, you have to really mind the P&L. I just have a lot of memories as a kid of him with his little notebook at night, running his numbers regularly, just very focused on that. I went to law school. I practiced law for about 10 or 12 years. Was a broad practice, did some litigation, did some deal work, did a lot of antitrust work. I got really interested in business because of that. I think when you have an antitrust practice, you see pricing, you see M&A, you see real business being done. Not all law practices are as close to the business. That led me to get interested in business. I went in-house at a solar company, a large consumer finance company, effectively selling solar finance. It's a really similar product to a mortgage in the sense that it's got a very long term, 20 to 30 years. It's for a big asset, probably after a house. It's the next biggest thing people buy with financing. It's got a very front of house, back of house dynamic, similar to mortgage. And a lot of the basic dynamics of competing for sales talent, driving operational costs as low as possible, those patterns emerge in both industries. I was in solar for about 10 years, did a bunch of jobs at the company I was at, started in legal, did some deal work, corp dev, BD, ended up leading product. I got very interested in the use of technology to reduce costs and improve customer experience in the acquisition of a consumer finance product. And if you want to build something like that, mortgage is the place to do it because there is so much scale, which is what led me to Snapdocs. And I became CEO about 18 months ago. It's been quite a journey going through probably the worst downturn in mortgage, but it's also been fun. It's been fun having to think about problems in a new way. And I think there's benefits to having sort of an outsider's perspective.
No, there's tremendous benefits having an outsider's perspective, and the breakdown you gave in 24 minutes, like the mortgage industry, and you gave a breakdown that I think you shared it. You know it better than a lot of people that have been in the mortgage industry for 30 plus years. You come from a different perspective, with that loan, that manufacturing background. You came from outside the industry, so. Just so everyone knows, Snapdocs, I mean, how many different lenders? I mean, I know a pretty big percentage of transactions are going through your platform right now.
Oh yeah,
Could you just share that real quick?
absolutely. Yeah, we have well over 100 lenders. I think we're approaching 150 lenders. We have many title branch offices. We touch about 1 in 5 transactions today with at least one product. And I think more than any other company, we have established the dynamic, a platform between lender and title for them to collaborate on closings. When I think about a closing, I think about the most complicated moment in the mortgage production, because this is the point at which you go from lender working with borrower or doing internal work to a less controllable environment where you've got a lot of parties. You've got lender, you've got borrower, you've got title. In some markets, you have title and settlement as separate entities. You have seller to some extent. You have a notary perhaps, and maybe some other folks. And all of these people have to coordinate to produce this asset, which is then going to be bundled up and securitized. So it's got to be a high quality asset and somewhat widgetized. You know, it's got to look like other assets. But at the end of the day, homes and home buying and home lending, it's a very consumer human process. It's kind of hard to widgetize. And so we've created a platform that allows lenders and title companies to collaborate and really streamline those interactions.
Yeah, it's a pretty incredible platform, guys. I have been following it for a while now. A good friend of mine is working there in sales, and I recommend you guys check it out. Like they're changing the game on the final mile of the mortgage experience and really helping lenders deliver what I think is the true modern experience. And I think there's two things that are not well modernized. The closing, you know, like let's face it, everybody's got an LOS, everybody's got a, you know, point of sale, they've got a product and pricing engine, and there's a lot of pretty mature technology that is automating the loan manufacturing process. I think closing is not as well automated as it could be, and I think consumer expectation is that it is a lot more automated than it is. And then I always make the case, what happens in front of loan manufacturing? It's very disparate, you know, like the way, like you showed some slides at the efficiencies, or let's just say the lack of efficiencies of how many people are in underwriting versus loan closed. Like that number has gotten worse over time, not better over time. How many loan officers versus closings, you know, that number's got worse over time. And so technology hasn't really paid off. Why don't you kind of make your case a little bit around the back end part of the process, you know,
Yeah.
as who's outside of the industry, coming into the industry, to put more focus on that.
Yeah, you know, would it be helpful if I pulled up the slide? I think I know the slide you're referencing from the Housing Wire event.
Pull up any slide you want, you know, like
You
pull
want
up
me to
any
pull it
slide.
up and just walk through it?
Yes. Yeah, go
Okay.
for it. You know,
Let me find
you
it.
did a lot in 24 minutes and you got another,
Yeah.
we got another
Well,
20 minutes.
that was a first run. I could probably do it in 23 minutes this time.
Yeah, right. I bet you could do it in 20.
I think it'll be faster than that, but let me see if I
Right.
can find it. I think I've got it here. There we go.
Yeah. By the way, while he's pulling up those slides, I don't think this was in a slide, but you said it. And it's something that I talk a lot about, that guys, if you are in mortgage, you cannot expect the lower rates to rescue an inefficient business. And I mean, there are some customer trends that the industry is not paying attention to. You know, you made the whole point that you know, what was the number you called out? It was the number of families and homes that are purchasing. It used to be like 12% of homes were purchasing annually, and now it's like 4.3%.
That's right. Yeah, we can
Like
look at that
that's
too. We can look at that too. I'm happy to skip through some of this stuff. So this is one of the worst purchase markets in you know, most professionals in mortgage have probably not seen a worse market. And the reason for that is, and we think about this as the percentage of homes that change hands, right, that are in a purchase market. And you have to really understand that, you have to look at how many homes there are. And so there are a lot more homes today than there were, you know, 5 years ago, 10 years ago, et cetera, because population is growing and home building, although slow, does add homes. And so you look at this year, you have 86 million owner-occupied homes, but we expect a purchase market of 3.7 million, which means 4.3 million of those homes changed hands. And sorry, 4.3% of those homes change hands. And if you look kind of at this right column here, that's a pretty low year. It's not the lowest, but it is historically quite low. And you know, the reasons are pretty obvious, right? We've been underbuilding. We have 13 years of rate reduction, so prices have been going up since the sort of Great Recession. And then in 20 and 21 through COVID, we had historically low rates. So there's a lock-in effect. People don't want to sell. And so you just end up with this huge unaffordability problem. And that's why no one's moving.
Yeah. And it's not like that's just going to get fixed overnight. It's going
No.
to require, and what I always advocate for mortgage professionals to do more than just quote rates and do pre-approvals. They need to help consumers make educated decisions. And usually people aren't moving because of the rate. They're moving for lifestyle reasons. And mortgage professionals need to show them that, hey, like, look at the value of moving up over 5 years, over 10
Yeah,
years, you know, start
right.
showing the net worth benefits of moving up.
That's right. That's right. And also just the lifestyle benefits. I mean, people at the end of the day, you said it, like people don't always move for financial reasons. They move because there's a life event, marriage, kids, death, etc. These are the reasons that people move. And I think that the industry needs to coach people on life happens and you can't plan around these things. Like you've got to
Yeah.
live your life and we're here to help you live your life.
Yeah, well, and also a lot of those life events they just called out are data events, and you need to make sure one of our services is that we're managing credit data, life event data,
Yeah,
aggregating that data, and creating opportunity recipes
that's right.
so that you could be at the right place at the right time in a predictive way to talk to that family and help that family. So
Yeah.
cool.
So you asked me to go through the P&L. Let's do that.
Yeah,
So
let's do it.
and I'll hit on this point too, which is it'll be years before we're back at historical affordability. And we don't expect a massive reduction in rates. We do expect some reduction, but not a massive reduction. Nothing like what we saw in 2020. And so if we're kind of waiting for volumes to go back to 8 to 10 million mortgage originations a year, I think we're waiting for something that's likely not to happen in the next 3 years. I think it's a new world, right? We had kind of average of the last 20 years, excluding the peaks and valleys, has been around 7 to 8 million mortgages. I think that average is probably closer to 5 to 6 now. I think it's a structural change to the market, at least for the next few years. And that means we have to change the way we operate. And so what that brings me to is the P&L. This is a pretty typical P&L. Expenses per loan at $12,000. This is, lenders today, I think a quarter ago on average, were losing maybe $600 a loan. I think now with a little bit of volume improvement, lenders are roughly break even. Some are making money. No one will tell you it's a bonanza. And so minding the P&L and in particular the costs is really important. It's important to the viability of the lenders. It's important to margins. It's important to how much you can pay salespeople. It's important to the rates you can offer. There's a real network kind of a flywheel effect in having lower costs. Any business with low cost is gonna always do better. And so when we think about cost at Snapdocs, we're very focused on the back office. And one of the reasons for that is we're really focused on closings, and closings are very much a back office function. It's not front of house. But I think the second reason that we're so focused on the back office is because every product we ship has AI in it. And what I'm going to go through here in the next few minutes, not 23 minutes, maybe more like 2.3 minutes, is a discussion about why we think AI, the best opportunity for AI actually sits in the back office. And so I've got, some color markings here. I've got yellow checks, green checks, red X's. When I've got a red X next to something, I'm not saying bad idea or never. I'm just saying not the place to start. And when I've got a yellow check next to something, I'm saying maybe you get this value, but that's not direct. When I've got a green check next to something, I'm saying that's the thing. And so let's walk through this top to bottom. So AI is not going to replace buildings or equipment. We are already probably as remote as we've ever been as a society post-COVID. We're probably pendulum swinging back. I just don't think that the advent of AI is going to get people out of buildings. You still need people to run this industry. They still need places to sit. And so, there are some lenders who operate very remotely and some who don't, but this particular lender on this P&L spends $776 a loan on occupancy and equipment. I've got a yellow check here because if you use AI to shrink your headcount footprint, or I should put it differently, in a rising market to hire less and get out of that hiring and firing cycle, you may not need more space. And so as a function of how much this costs per unit, you may actually see the number go down, which is why it's a yellow. It's a secondary effect and benefit of automating and using AI. Next category is technology and professional fees. These are fundamental to the business process. You need to have a broker license if you want to sell a loan. AI is not going to make that stop. The government's not going to say, oh, you used AI, you no longer need to be licensed. So this fee isn't going anywhere. Likewise, you can't run a mortgage lender without a POS and an LOS. These are not optional pieces of technology. And I mean, I guess they could be optional if you want to run a mortgage lending outfit on paper and out of Excel. I don't think anybody does that today. So this has got the red X, right? AI is not going to make these costs go away. And in fact, what you'll see in the mortgage industry and in literally every industry over the last 20 years and over the next 20 years is that technology as a percentage of the cost stack will always go up and other costs will come down. This is a function of the software is eating the world claim that, some of the big venture capitalists have made. Like software changes the way businesses operate. So looking for savings in technology is actually, you will see technology costs go up. You will see savings other places. I think that's the general trend that we should expect. The next one I want to spend a few minutes on because I think there is a lot of AI work going into sales. And we've got the red X here, and it's not because we think it's a bad idea or it's not something we shouldn't do. We think it's complicated, and we think it's just not the most obvious place to start. And so here's how I think about this problem. Sales is a super high judgment activity. You're dealing with a borrower. You're taking in a bunch of their information. Some borrowers are really easy to underwrite. They want a really down the fairway kind of loan. They've got a, perfectly acceptable credit score. All of the ratios are correct, loan to value, et cetera. But not everybody looks like that. And then you start getting into judgment. And then you start getting into lender policies. And some of this stuff can be automated. Some of the best work I've seen here has been copilots. It's been AI-based copilots to supercharge an LO's decision-making. But are we actually going to replace the LO with AI? I think we are very far away from that. I think there are regulatory reasons. I think there are customer experience reasons. I just don't think it's the thing. Interestingly, the reason so many people are so focused on sales as the part of the P&L they want to attack is because sales is expensive. But guess what? Sales is expensive in every industry. Like it costs money to win customers. And so people may not like that this number is so big, but I don't think this number gets shrunk by 50% because of AI. I don't think that's the journey we're on. The next one's production support. I kind of throw that in sales. I sort of see that as like the support that supports sales. Some of this might be more susceptible to AI because it's more manual repeat work, kind of more high velocity work. AI really excels at that. But I'm thinking in terms of like departmental moves. So you've got sales at 3,100, you got production support at 900, you have $4,000, a third of the cost stack. And I think that's why people are focused on sales. When I think about the back office, and you get fulfillment and operations, this is where we get excited. This is $3,700. So this is really on par with sales. And for some reason, it's a little bit harder to get people to focus on. And I sort of started this conversation by talking about my upbringing, and my dad's he's an engineer and he's very numbers oriented and he's very operational. And I just watched him as a kid, like with his pencil. And I'm sort of the same way. And so I love the P&L. Like I think of the P&L as a treasure map, and I spent a lot of time in it. I think that a lot of company leaders shy away from that kind of work because it's boring, because it's rote, because there's that saying that like sales cures all ills, and it does, and I feel that at Snapdocs too. But when you can really get deep into your operations, there's a lot of magic there. First of all, a lot of the operations in mortgage in the back office are manual, lower judgment, not borrower facing, and they're kind of simple decisions. They're lower risk. Determining whether or not a page is missing or a signature is there is not like a sink the company kind of decision. And so these are tasks that AI really excels at, and these are places where you can reduce the cost dramatically. And so we think this is the place to start.
Yeah.
There's actually a lot of magic that also comes out of, it's not just cost reduction. There's a lot of magic that comes out of this, which is, and we talked about this a minute ago, we're in a scaling market. We've hit the bottom. We've got rate reductions coming. We're in the next cycle. It's about to start going up. I think lenders have a choice. They can start staffing ops people, or they can make the ops people they have more effective with AI. And when they do that, they focus those ops people on the higher value, more difficult work because AI does the easy stuff. then those ops people can be paid more because they're doing harder jobs. They're processing more loans per person. It becomes a better job. It becomes a job they want to have and they don't cycle out of. And then you get out of this hiring and firing cycle and you actually create careers for people, which I think that level of sustainability and professionalism is really good for the industry.
Love that. Well, I know we've got to jump, so go ahead and stop sharing your screen.
Oh, sure.
And I want to kind of share a thought that I think could be helpful on both sides, beyond loan manufacturing, within loan manufacturing. You came from outside the mortgage space, and now you've had a chance to jump into this industry. And to me, technology is changing the world. But in order for technology to be implemented, and then even when it's implemented to be used effectively, it all starts from a leadership perspective. It starts with how lenders make the decisions to acquire technology. It's how lenders implement that, how they train their team. And personally, I think, there's a whole lot more tech to be had than what's being implemented. And even I see a tremendous amount of waste. Like, I think the biggest line item in the P&L in terms of expenses is either underutilized technology or poorly adopted technology. What are your thoughts? Like, you get to speak to the mortgage leaders on both sides of the fence right now as a guy coming from the outside, and isn't that the biggest line item in the expense bucket?
I don't think that technology itself is the biggest line item. I think
No,
buying
leadership, a lack of adoption.
I think that buying the wrong technology or not implementing it or not getting the value out of it is a huge expense. And it doesn't show up in the P&L as technology expense. It shows up in the P&L as inefficiency. But I think the issue that I see often is there isn't a clarity of thought around the problem you want to solve and what you expect the technology provider to do. We talk to so many lenders who bought products and we say, hey, are you getting success with that product? And they say, no. Like, well, then why are you using it?
Or they say, I don't know. They don't know.
Well, that's true. Sometimes they don't know because they're not actually measuring the things they need to measure. And so a lot of our sales process and a lot of it's actually funny to even call it a sales process because I think of it as more like a consulting process. But a lot of our process is talking to lenders about what are your goals? How do you want to measure them? And do we think our technology can actually help you achieve those goals? Because we're willing to sign up to be measured.
Yeah, that's our strategy too. I mean, we came from a data background, and conversion is a big issue. Lenders don't measure it at scale. And one of the things in this Moneyball mortgage series, which I'm probably going to make this part of Moneyball Mortgage, with how can AI, where should you invest in AI to be more profitable? But they're not measuring conversion, and they're not measuring their vendors based off of their ability to improve conversion. If anybody wanted to, learn more about your platform, what's the best way to learn more? And if someone I don't know if you're active on social and LinkedIn or anything, but what's the best way for people to follow you and learn more about Snapdocs?
I'm not super active on LinkedIn, but I post from time to time. I'm happy to receive messages from folks. We have intake forms on our website. That's pretty easy too. Yeah, we're pretty easy to find and we're friendly. I'm quite responsive.
Yeah. Well, are you speaking at any more events in the coming year? Are you slated for any more?
I don't think I have anything scheduled. I do really enjoy it. I think it's the lawyer in me.
Yeah. Yeah. Well, you really did a great job. I'm going to see, I know Clayton made the recording available to people that attended the event. It was 24 minutes. I'm going to see, put it this way. If you're watching this on YouTube, there'll either be something telling you how you can get a link to watch the event, or maybe there'll be a way that Clayton will let me share it. But, if you're not, subscribing to Housing Wire, you should. I'm going to be at the AI, or not AI, but the IMB Summit. They're really doing a great job. Any closing thoughts? You're talking to primarily people on the sales side of things, but any closing thoughts or words of advice to the sales side of
I do. Yeah, I appreciate the opportunity. It's that a lot of people forget that operations is a customer experience. It takes 70 days on average to get a mortgage from application to close, and I think that's too long, far too long. And what we are really obsessed with as a problem at Snapdocs is how do we make that experience as short and as painless as possible? And I think if a salesperson is really focused on, let me just get them to agree to buy a loan from me, and then everything I'll throw it over the fence and I won't worry about what happens after, I think they're missing out, because I think the opportunity to really improve that experience will generate referrals, will generate repeat customers. And we have customers who believe this deeply. We have customers who came to us not because they were seeking operational savings, although they're getting that, but actually because they saw digital closing at high adoption rates as a differentiator to recruit sales talent, to win customers, et cetera. We have some big customers who are growing rapidly, who are using us as a real differentiator.
Yeah, that's a really, really good point. So for mortgage professionals, that means your customer satisfaction scores go up. I recently made an introduction to you guys and experience.com, and I know you're talking to other companies that do reputation management. And guys, you will find that if you can get the transaction right, you're going to get higher customer satisfaction scores, which is going to lead to more referrals, which is going to lead to more retention.
Right.
And so, which again, here at Trust Engine, we obsess with, beyond loan manufacturing. So the minute a loan closes, make sure that you're helping people achieve their goals. You don't know this, Mike, but one of the things that we teach is show them how paying an extra $100 or $200, how much interest they'd save over time and how much faster they'd pay off their mortgage. Provide them with an annual review, showing them how their loan compares to the market. And then always, like, our whole theme is optimizing for financial freedom. Like, home ownership is part of the American dream, but the full American dream is home ownership with financial freedom. And we believe that the mortgage industry obsesses with a 3 to 5 month process, which is, pre-transaction, transaction, and post-transaction. And we need to obsess over a 30-year, 50-year journey with a customer to really help them achieve homeownership with financial freedom. And
I think that's right.
love the work that you're doing, my friend. I look
Thank
forward
you.
to more collaborations. And this is a wrap. If you got value from this, give it a like, share it with other mortgage leaders that you think would get value to it. If you're not already following savageinsights.com, that's where I'm posting the most recent content I do. So go to Savage Insights, check it out. And be sure to follow Snapdocs and forward it to your C-suite. All right.
Dave,
Take
thanks for
care,
having me.
everybody. Yeah. Thank you, brother.